let's run through some of the questions that we've been thinking about here. Andrew, I'll start with you. Do you think inflation comes down? And if it does, are we going to go back to the levels that the Fed is looking for, 2% or so?
Well, right now, we have received some positive news in the last couple months that shows that potentially inflation is peaking. But to be fair, I think it's unclear right now exactly whether or not this really is the peak. I think it's going to take some additional data points to confirm that. And the Fed's going to have to be vigilant on making sure that it stays focused on bringing that inflation rate back down. The Fed said very clearly that they want inflation back down to 2%. I think we should believe them on that. That means they've got a long way to go, and this fight's not over yet. What's the stickiest point? Is it getting into wages at this point, Andrew? Well, I think it's a lot of uncertainty. You know, first of all, the geopolitical uncertainty makes monetary policy more difficult right now. As we've seen, the war in Ukraine in particular has had a pretty big impact an unpredictable impact on energy prices, and that going forward could suddenly change. We see, as your last guest just said, we've seen some positive changes in energy prices, but that could quickly reverse. There's a lot of uncertainty facing the U.S. economy right now, and I think that's what's made the Fed's job particularly difficult, and also the forecast forward on the future path of inflation. Again, I think we've seen some positive data recently, but I don't think we're out of the woods yet. Stephanie, how concerned are you about inflation? How concerned are you about declining economy and job losses?
That's the primary concern. I mean, for me, Becky, inflation has always been the relevant risk. So I'm always concerned about inflation. I think, we are, in a sense, shifting gears right now. And I think markets have shifted. And I think the consensus is more or less that inflation has peaked, that's mostly a rearview mirror problem, not to say, as Andrew just laid out, that there isn't a lot of uncertainty and some volatility and geopolitical risks and anything in a sense could happen. But all signs point to decelerating inflation in 2023. And I think the relevant risk has become recession risk. And I think that's what markets are mostly concerned about. And that's where I am as well.
Let me just ask you, Stephanie, I mean, we've been kind of tossing it around the last week or two. Just the idea of inflation really working its way into wages. And because the labor market is so tight, employers not having much choice. I mean, it's just such a weird position to be in where you're trying to fix the strength of demand by breaking the market, but you're also faced with such a tight labor market. And that's maybe different than what we've seen in the past. What do you think?
I think you used the right word, Becky. I think when you said it's weird, it is weird because typically when we talk about a tight labor market, we're talking about a labor market in which real wages are increasing. That's what usually happens in a tight labor market. But of course, that's not what's been happening. And so, things are very strange. It is, in some sense, a bit weird to describe the labor market as tight. And yet we know that employers still are having some trouble finding workers. The number of opens far exceeds the number of people looking for jobs.
Right.
So
wages are up. They're just not up as much as inflation because inflation has been so high.
That's right. And they are decelerating.